Well, I know that we are always really big on, hey, when a lender asks for something, drop everything, get it to them because they're asking for a reason. It's usually time of the essence. We want to get this out of underwriting quicker. Let's get this information over to them. So therefore, they're not waiting on us. They're not waiting on you. We're waiting on underwriting, and that's how we should be waiting on them.
I'm Robynn Skaggs. I'm with the Mortgage House. I'm actually a mortgage broker.
Robynn is one of the brokers that we've dealt with and had dealings with. And I thought if I was going to ask a few questions, what better person than to ask you to
I appreciate that.
see if you can go ahead and help us out. And some of the questions that we get a lot of that we, end up passing on to the mortgage broker and say, hey, you need to ask your mortgage lender. The first one is, what's the difference between pre-qualification and a pre-approval?
So that's a good question, Chris. The difference for me between a pre-qualification and a pre-approval is basically a pre-qualification is just basically when you're talking to somebody and you're giving them just basic information and they're just telling you whether or not they think that you could be qualified.
Okay.
What I prefer to do is I like to do pre-approvals because I like to go into depth to make sure that if you do go under contract, the likelihood of it falling apart is going to be bare minimum. I mean, things happen, but I like to go a little bit more extensive. I like to pull the credit, see exactly where we're sitting, what exactly is reporting to your credit, because a lot of people are surprised. There's sometimes a delinquent that's reporting to your credit that you're not even aware of that could potentially tank the whole transaction. So I just like to make sure that I have all of the correct information. So when you do become under contract, it doesn't fall apart.
And that's probably good information to know ahead of time so they're not mad at you because you've
Exactly.
pulled the rug out from underneath them, so to speak.
Exactly. And then they're not losing their earnest money.
Okay.
So that's a big thing too.
Now, when you go through the pre-approval, you're actually getting documents from them that prove their income, that prove what they say over the phone, because sometimes, not all the time, some people like to embellish
That is very true.
or sometimes think that they make this amount, but the difference between gross and net does make a difference, I'm sure.
It does make a huge difference. So we always go off of gross. The number one thing that I generally get whenever I'm doing a pre-approval is your pay stub, your most recent pay stub. I want to see exactly how you're paid, how it's broken down. Sometimes we're not able to consider bonuses that you would think that we could consider. So I always double check pay stubs.
Well, that being said, what are some of the I know there's a lot out there, but what are some of the loan products that you offer or that you see the most of that are out there that could be a benefit to people?
So, I mean, we do the basic loan products as far as conventional, FHA, USDA, VA, things like that. I would say the most utilized one is probably going to be conventional and FHA. The most underutilized one, in my personal opinion, is USDA.
Okay.
Everybody wants help with their down payment, and USDA can offer that. It's a 0% down program, and it truly is a 0% down program. I think that it could be beneficial to a lot of borrowers, especially out in East Texas, because a lot of houses qualify for it.
Because that basically works for homes that are outside the main city limits of Tyler, Longview, basically that is considered a rural setting, correct?
Correct.
Okay.
So I've found that most houses in Tyler do not qualify for it. And then there are some houses that can qualify for it in Longview area, but those are the two areas I would say we would have to be very careful with.
Okay. And let's say that we got the right loan type for them. We've got them pre-approved. And let's say we get them under contract. What would you say? How would you explain the loan approval process from we're under contract through closing and them taking possession, underwriting, that kind of stuff? Is it?
So basically, I like to say when we're under contract is generally the time where hopefully the borrower is not stressing. I like to say that's my job to stress for them.
I take some with it.
You do. So a lot of it is, this is my time to start collecting documents, the documents that we need to get us into underwriting. And it's just your basic documents, like your income documents as far as W-2, your pay stubs, are you 1099? Do we need your tax returns? Things like that. Updated bank statements, where your assets are coming from. So it's all the big documentation just to initially get us into underwriting. After that happens, depending on which lender you're with, it could happen fairly quickly. We can be out of underwriting within 24 hours, but sometimes it takes a little bit longer depending on the lender. But once we're out of underwriting, we get a sheet that basically says, your loan is approved, but once we satisfy these conditions.
Okay.
So there's a bunch of different conditions depending on the situation that the underwriter's wanting to see. And so then I bother the borrower again for more documentation. And that's pretty much how it goes, as well as ordering appraisal. So we're waiting on the appraiser to come out and get the value of your property and see if it's worth what the lender is willing to give you the money for.
Gotcha.
Surveys being ordered at this time as well. So really, hopefully everything's going smooth and the borrower can just sit back and let us work behind the scenes and they never end up stressed at all in an ideal world. And so by that time, once we're out of underwriting and we go back in, hopefully just one more time into underwriting, we'll get our clear to close. And once we get our clear to close, we get to sit down at the table and sign papers and give you the keys to your house.
Well, I know that we are always really big on, hey, when a lender asks for something, drop everything, get it to them, because they're asking for a reason. It's usually time of the essence. If we want to get this out of underwriting quicker, let's get this information over to them. So therefore, they're not waiting on us. They're not waiting on you. We're waiting on underwriting. And that's how we should be, waiting on them.
Or waiting on the appraiser. I mean, there's many different factors that causes us to wait, unfortunately, but I like to try to get everything in pretty quickly and get us out of underwriting and just wait for closing. I like to have our clear to close, and then when everybody can sit down at the table, then we can get that done. But I would say that I do have a lender that on average can close a loan in 14 days. And so if the borrower can get us the documentation quickly, we can actually make the 14 days happen. I mean, I've seen it all
as long as the title companies,
as long as the title,
they
I mean, as long as the ideal world, the title company, the appraiser,
but
the
on
surveyor,
their end,
if everybody's checking the boxes together, then yes, we could close fairly quickly.
So, I know percentage, interest rates, all those are very specific to every person individually. But as opposed to, let's say, credit score, what's a number that would make someone think that, hey, I have a chance to go ahead and have a conversation? I mean, are we talking 650, 600, 550, 700? What's a range there that someone could feel comfortable, having a conversation about, moving forward?
So honestly, I have lenders that'll go all the way down to a 500 credit score.
Okay.
Now I will say it's not going to be your ideal situation where we're closing in 14 days.
Right.
If we're closer to the 500. But yeah, I mean, it's always worth having the conversation. Even if you're not a 500, have the conversation so we can work on your credit and figure out what's the best route for you. But I would say if you're below a 580, the likelihood of you having to put 10% down is pretty high.
Okay.
So if you're looking to have your minimal down, I would say have a 580 or higher. You're going to get a better rate. If the higher your score is, the better rate you get. So, I mean, those are many different factors that.
Okay. Well, then let's wrap this up with a question that a lot of people hear a term of locking it in. You hear the lender say, hey, we need to get you locked in. What does that term mean? How long is it normally good for? And is it necessarily a good idea?
Yeah. So when you're locking in your interest rate, it's something that you do have to do before you close, because that's going to be your interest rate throughout the life of the loan if you're doing a fixed rate.
Gotcha.
So, I mean, the locks can be very customized. If we're floating for a long time during the process, and floating basically means you're gambling at what interest rate you're going to get, because it's all a gamble, right? Nobody knows what the market's going to do.
Gotcha.
So let's just say today, hey, Chris, do you want to lock in at a 6.125? If you agree to it, we're going to lock that 6.125 in, and it's going to be good throughout the life of your loan because we're doing a fixed rate. So, I mean, it is important. It just depends on, are you a gambler or not?
Right.
Do you think that the market is going to get better? Do you think it's going to get worse? I mean, I can give you the clues just from what I know, but again, it's still a gamble.
You're still dealing with the government entities of setting who sets interest rates and stuff like that.
I mean, and people don't realize that everything in the market, basically what controls the market is everything that's going on in the world. If we're in a war, that affects the rates. Tariffs affects the rates. There's so many different moving parts, coming into a president election.
Yeah.
With the market not knowing who's going to be elected, it was really shaky.
Yep.
But once the market finds out, it adjusts. So, I mean, there's just so many different things that go into the market, but we always have that discussion, and I never lock anybody in until I do have the discussion. But I mean, we could lock a rate for 5 days. We could lock the rate for 30 days, which is more customary.
Mhm.
You know, you want it to be locked in throughout the whole loan process, because after the loan process, then that's just your set rate. Now, if I locked you in for 30 days and for some reason the process is taking longer than the 30 days to close you,
Right.
well, then we start talking about extensions, which cost money. So you're
Gotcha.
just basically paying to make sure that you kept that 6.125. So, I mean, that's essentially what that means.
And we don't want to pay extra, but sometimes you have to.
Definitely don't want to pay extra.
Exactly. Well, anyway, thank you so much.
Yeah.
I hope this clears up a lot of information for you guys out there. And if you have any questions, reach out to Robyn with the Mortgage House, Robynn Skaggs. Thank you so much.
Thank you for having me.